so please don't mind the mess in the room. Anyway, but hopefully this will work and you'll be able to see everything up here. But so here we go. Don't know if you can read this. I'm looking at the screens backwards, but this is the mathematical approach to profiting in the stock market. So in the beginning of the paper, what I talk about really is how to go about selecting an individual stock. I use two main ways to determine what kind of a stock that you want to invest in or you want to purchase and sell. So the first one is what we call data mining, or data mining is really just when it comes to stocks, it's all numbers. You can have a number for anything you can think of. Somebody's got a statistic, a historical chart, something to tell you what you're looking for. The big one, the one that a lot of even like long-term investors and day traders use alike, is the price to earnings chart. The price to earnings is exactly what it sounds like. It's a chart of the price of the stock versus how much that company will earn on that stock. So a lot of people will look at this and because it's a really great indicator of if a stock is doing well, or if a company is doing well, and kind of the trajectory. So a positive price to earnings, and we're obviously making money. You can have a negative price to earnings, which is they're losing money, which is obviously a red flag. Most investors and traders, bulls, tend to stay away from a stock with negative price to earnings. But so in my paper, I highlight Apple. A lot of these price to earnings graphs, and you'll find with a lot of the graphs of various statistics for these stocks, is that they're relatively patterned. You'll see Apple's price to earnings tend to stay anywhere between like about a 10 to up close to like a 20. So what you want to do is, if you see that Apple's starting to get down there, that price to earnings is down low around 10, now you know that, all right, that's cheap. So it's selling cheap relative to how much you're going to earn on it. And especially given the fact that it tends to fluctuate. So it's going to end up looking like a sine graph, this price to earnings graph. You're going to end up getting it here, and we'll have, say you have about 10 right here, and you have 20 up here, and then maybe, say, 6 months, a year. You're going to get it, so it's going to be down here for maybe a month or two, go up, come back down. So when we're down here, this means that the stock is selling relatively cheap towards the earnings. So this is the time to buy. So if you buy here and then we want to sell once we're getting up close to the top here at around 20. Usually in between here you can find a good 15 to 20% jump in the stock. And a 15 to 20% jump in the stock in a couple of months here is a great return, because in general stocks return about 10% in a year. And in terms of any other type of like bond market or just leaving your money in the bank with interest, 10% a year is about the best you're going to be able to do in any other way of investing. So to be able to make 15 to 20% in a couple of months is obviously even better than just the average of the best way to invest. So there's clearly money to be made here. If you're making a quarter of your money back in a year, that's better than having it sit in a bank where you're making maybe fractions of a percent in a year. So that's just one of the ways that stock traders will determine what stock to buy and when to buy it. Another thing that stock traders are going to do is they're going to pay attention to what is being said in the news about these companies, especially now, given the technological revolution and just with the TV, and everybody's got their own channels. There's a whole channel just dedicated towards stocks and bond markets and stuff. Everybody's talking. The internet, everybody's talking about everybody. So it's important for stock traders to stay ahead and to know what's being said about a specific company because we live in a very influential community. So if somebody comes on the TV and says, Apple, I don't like these next 6 months. The figures for their iPhone sales don't look good. Then people will react to that. And generally, if you hear somebody on the TV say something like that, you look at the stock price. The stock price will adjust accordingly. Um, a great example that just happened is Samsung. When Samsung just came out and they said, people started figuring out this new phone, this S7, was liable to blow up, to catch on fire. Uh, Obviously, that's going to hurt phone sales, and you hurt phone sales. Stock price got the stock price got crushed within a couple of days. The stock price dropped maybe 15-20%. And if you had Samsung stock and you knew this was coming, obviously you would want to sell, which is what most people did, which is what drove the stock price down. But here too is where this is the where real stock traders or investors kind of come to. This is their time to shine here when these stocks will come down. The biggest thing for the stock market is this concept of you want to buy low and you sell high. So Samsung drops 15-20% in just in a matter of weeks because of this. But it's Samsung. Samsung's been around forever. Samsung is not a one and done company. It's not a here today, gone tomorrow company. Samsung's been around forever. They made it through the dot-com boom and bust. They've been through the 2008 housing crisis, and they've always been able to recover. So they have a track record of recovery. So when they drop 15-20%, what a lot of investors did is, okay, as soon as they see it starting to bottom out, they're going to jump in there because they know it's going to go back to where it was. And sure enough, in another couple of weeks, it was back to where it was and then some. So in a couple of weeks, if you had bought it at this buy low and then you held through, you made about 20-25% just a couple of weeks, which again, when you're making 10% in a year, generally in the stock market, which is in itself already much better than any other type of investment. If you're making 25% in just a couple of weeks, you can do that maybe 3-4 times a year, you're almost doubling your money in a year. So there's staying ahead and staying aware of the situation surrounding a company is also of key importance in deciding what stock to buy. But this paper is more about, or this presentation, less about how to find stocks to pick, but more about once you've decided what stock to pick, how to manipulate what we call stop losses and stop limits to make it so that even if you lose sometimes over the long haul, over a long period of time, you're going to average gaining money and hopefully gaining more than just that 10% a year, even significantly more if you can learn to do this correctly. But so here I'm going to start introducing some more mathematical principles, and hopefully I'm going to put these on the board. I'm going to hope you can see them. I'm looking at myself right now, and it looks pretty good, so hopefully this will work. So the first thing is, the key is that to realize that when you're investing your money in the stock market, your return is it's compounded. It's going to follow similar to a compounded interest formula. So here, I'll write this down. So the regular compounded interest formula, you're going to have, we'll call A as your total, and it's going to equal your P, which is your original investment, times 1 plus your rate of return over the number of times you're returned. And you're going to raise it to the power of the number of times returned times however many time periods. Generally, this will be your rate in a year, how many times it's compounded per year, and then raised to the number of times compounded per year to the number of times the number of years compounded. So interest will follow this general formula, but what we're going to do is I'm going to take this formula and manipulate it a little bit to follow more of a stock market approach. And I'm going to show you how you can set these stop losses and stop limits so that you're guaranteed to be profiting here. So the first thing we're going to do is I'm going to change this R over N here. This R over N is going to become what I'm going to call Y, which is going to be a function that I'll introduce. And then I'm going to, instead of this number of times years, we're just going to do theta. And I'm going to show you what both the first, theta is going to be the number of times that you buy and then sell a stock. So the buying and the selling of a stock will count as one trade. So take that there's generally, at least most of these numbers I'm going to be putting up are also relative to myself. I've been doing, I kind of got into this within the last year or so, and these are the numbers that I kind of use, and this is generally geared towards more, I guess, a smaller time investor. I'm not investing over here with loads of money. So a lot of these are based on my experience. So a lot of these numbers will be, that's what they'll be geared towards. So theta is the number of times that we'll buy and sell the stock. And we'll say for in a year time. We'll do 1 year. Basically what I've found is that I can do about one trade will go per week. Sometimes you'll get 2 or 3 trades a week. Other times it'll take 2 or 3 weeks for one trade. But in general, about one trade a week is pretty fair and pretty expected. So I'll say that generally we're going to say 52 weeks in a year, we'll call it 50 just to make it even. So theta is generally going to be 50. So we're going to say theta equals 50 trades per year. Okay. So now here's where the manipulation occurs that is going to ensure profit. So Y. This is what Y is going to equal, and then I'm going to write it out, and then I'm going to introduce it step by step. So Y we're going to say it's going to equal A times alpha minus B times beta. Okay, so A is going to be the percentage. So these are percentages. So these are decimals out of 1. The percentage of time that when you buy a stock, when either the stop loss or the stop limit is. All right. Well, hey, let me backtrack a second here and introduce what a stop limit and a stop loss is. When you buy a stock, you can set a stop loss and a stop limit. A stop loss is going to be you set it so that if the stock price falls to a certain level below where you bought it at, so say it drops $2 from where you bought it at, your stop loss will trigger and you'll sell the stock and that'll be the end of it. Generally you set a stop loss to ensure that if something ends up tanking, or something comes out in the news again, or some extenuating circumstance, that you're safe. You don't get caught dropped 15% in 2 hours, and you're none the wiser. You look back at your phone or you look back on your computer, and the stock has dropped 15%, and you missed your opportunity to sell. So when you set these stop limits or stop losses, it's kind of like, all right, this is the floor. If it drops below this, I'm out. And in the same respect, the stop limit is if it hits a certain price above where you bought it, we're out. We're good. We're going to take the money and we're going to run. So that's what a stop loss and a stop limit is, and that's basically the key here. So going back to this formula, A is going to be the amount of time that when you buy a stock, your stop limit will trigger, which means basically that you've made money, that we'll say you've won this round. So I found that you I do slightly better than 50-50. Um, Given I'm new to all this and don't have that much experience. But again, trying to use not only these data mining but also these text mining ideas to go forward and trying to pick these stocks that it's helped me to be a little bit better than not I'm not getting everyone right, and it's impossible. Even the best traders don't get everyone right. It's not you can't. It's impossible. It's too volatile, and there's too many extenuating circumstances, and nobody can predict the future. So it would be impractical to think that you're going to get it right 100% of the time. But so for our purposes, I'll say I get it right. We'll say about 60% of the time. I feel like so like every 6 out of 10. So 60% of the time, or I'm going to get this. A is going to be that I'm going to hit my stop limit, which means that I'm going to pick a stock that is going to go up. Now, generally, I'll set, and again, the key with making money is obviously that you want to win more than you lose. You want to when you're gaining money, you want to be gaining more than when you're losing it. So you'll set your stop loss and your stop trigger accordingly, or your stop limit accordingly. You normally will set them with a percentage. So you can say that if it goes up 3%, I'm out, or if it drops 3%, I'm out. But again, what you want to do is you want to make sure that you are making more than you're losing. So what I normally do, and what most newcomers do, and just for the simplicity of it, I started out with doing a 2% gain versus a 1% loss. So I'll set up that my average stop limit is 2% gain. So then this will leave that I'm wrong about 40% of the time. So call it 40% of the time. And again, when I'm losing, I've set my stop losses so I'm only losing 1%. So I'll make that 1%. So this is going to be this Y here. So now we'll have a new function here that is my new total after 1 year is going to equal, for this I'll say that I'll call P 1,000 just for to make it easy. So say you initially invested $1,000. All right, you're going to times this one. We want to make sure that this Y, basically what we're really trying to do is maximize this Y, given knowing that you're not going to guess right all the time. And you might not even guess right most of the time. I'll even show there, but for now, assume that you're right, that with a little bit of experience and time working with these techniques of finding what stocks are due for a price increase, that you're able to do about 60-40. So we're going to end up getting, here I have the numbers here written down, that this is going to be 0.008. And then again, we're going to be, we'll say we trigger trades about once a week, so call it 50. So that at the end of the year, when you do this all out, you're going to end up with 1,489. Now remember that the average would be 10%, so you could average here about 1,100. But here, this is in 48. This right here is in 1 year. That would be a 48.9% increase in a year. And if you take that, you're not going to find that anywhere else. You're not going to go to a bank and get someone that's going to pay you almost 50% in interest. You're not going to put that in the bond market and get almost 50% back on your money. The only way to do this is to play this stock. But again, remember, this is only being right 60% of the time. The key is that when you're gaining it, you're gaining 2%. And when you're losing, you're only losing 1%. And it's also important to realize that it's compounded. So you're raising it to this 50 pound, however many trades you're making. So this is what I average here. So I found that and this number has held true as well. That about 50%. So in 1 year, you can expect to get a 50% return. But then again, remember that that's compounded, so that next year when you start, you have 50% more. So you're starting with about 1,500. Do it again. At the end of that, you're gonna have 50% of 1,500. Do it again. You're gonna have 50% of whatever 50% of 1,500 is. So the compounding is what if you can understand that concept of the compounding, you realize the allure of this investing in the stock market. And some people dedicate their life. This is all they do, and they've gotten it so that they're right 80% of the time. They're right 80% of the time, and maybe they're setting, and they're so good that they're able to set their limits to 3% versus only a 1%, so that their gains are people gain. You can gain more than 100. You can double your money in a year. But again, those are more skilled. They generally will have some sort of scanner, some sort of computer scanner that will show them, specific numbers that they're looking for, or a combination of numbers that they're looking for that correlate to stock price increase. But this is me here after a couple of months of just kind of getting my feet wet with it. But I'll take this even a step back here. So, say that you're brand new and that you're not able to do this 60-40. You find that when you're getting a stock, you're basically picking at random. So the chances of it going up or down are about 50%. So if you even make this, say 50%, 50%, you're still doing a when you stop, your limit will trigger. You're getting about 2%, and your stop loss is triggering. You're still only losing 1%. That's really, really the key here, because this will still be positive, so that you'll get here. A is gonna be there's 1,000 again. This time it's gonna be 1 plus this 0.005, and then. Again, we're trading about once a week, so call it 50. So in a year, you can still expect to get 28.3%. So if you have no idea, well, I won't say no idea, but if you're trying and you're new to it and you don't really know yet how to pick these stocks, if you're only getting it right 50% of the time, if you've set your limit to 2% and your loss to only 1%, you can still expect to make almost 30% in a year, which again is 3 times 10%. And again, this 10% for the stock is still more than you can expect to get anywhere else. So being able to get this 30% in a year, imagine if you could take any number or any amount of money, and then in a year get 30%, get that back plus 30%, and that's you can almost, if this is 50-50, you can almost do this without you can just randomly say, you know what, today I'm going to buy this, set it 2%, 1%, and just go forward. And if you average over the long run, you're getting about 50-50 triggers. You're getting about 30% a year, which again, compared to leaving it in the bank with your interest rate, is ridiculous. I have one more. So now let's say that you're just really bad at picking these stocks, or for whatever reason you've hit a rut here, and or just the market in general is down. You're not able to pick even 50-50. This time we'll switch it from the first. So instead of getting it right 60% of the time, you're getting it wrong 60% of the time. So you're right 40%, you're wrong 60%. If you do out the math here, you're still getting 1,000 times 1.002. You're still getting a positive here. So if you can make Y positive, you're good. So even if you have 40% versus wrong or right versus 60%, if you've set these limits and uh, losses such that the limit is large or is bigger enough than your loss, then you can ensure that you're still making money even if more times than not you're losing on a stock. Because if you do this, uh, you're still getting a little bit more than 10%. So the the average return of about 10% is cumulative, and it's all encompassing. You're gonna have this includes traders like me who are just one singular person trading maybe like 10 shares at a time, and it's also the Fidelities, the E-Trades, the big institutional traders who will trade hundreds of thousands of stocks in a day. And it includes these professional traders. Their job is portfolio managers. Um, so more often than not, people that are trading are educated in the market and are gonna pick winners more often than they're gonna pick losers. So that's why generally you will see that. Stock returns are about 10% a year. But again, even if you're getting it wrong more than not, you can still make that 10% if you're setting your limit and your loss um, accordingly. So it. I'm not going to say that you don't have to do any research on what stocks you want to buy. It'll certainly help. It'll certainly make it a lot easier to maximize this why. But if you have no time to look at stocks, you have no time to be on the TV seeing what people are saying about stocks, you have no time to go and look at these price to earnings charts, you can still make money in the stock market just by adjusting your stop limits and your stop losses, um, so that when you're making money, you're making more money than when you're losing money, even if you're losing more often uh, than you're winning. But certainly, if you can manage to be positive, if you manage to get, like I said, like after just a couple of months of doing this, I've managed to get it right a little bit more than I get it wrong, then you can really stand to make a significant profit. 50% in a year is really incredible, and I'm really kind of looking forward to seeing if I can prolong this 50% a year. Because it's almost at this point, it's just been a hobby. Uh, but if I'm making 50% of the money in a year, then this might turn into more than a hobby. So it's been interesting to kind of not only to find this formula and do all this out, but honestly, at the same time, to actually be able to do it myself. I got uh, the app on my phone to trade and stuff, and just kind of like getting the real world experience of what this function correlates to. But again, hopefully that somebody who doesn't know anything about trade, if you can pick up and you can work with this formula, uh, you can see how easy it really is to profit here in the market, and it's what a lot of people have done. A lot of people make a good living doing it. A lot of people are able to retire early. Um, I've been doing this now. I've showed a couple of my friends, and I've even gotten a couple of friends to invest in me, um, because they see that the system it works. It's all just math. There's no You can't argue with math. Um, yeah, so but I've had a lot of fun doing this project here. So thanks for watching. My screen just went to the screensaver, so I'm really hoping that it picked up everything. I hope that you'll be able to see this clearly, and I hope that it made sense, um, and I hope that you pass me. So thanks for watching.